2:30. I think I'm going to get started so we can end on time. Thank you for coming. We appreciate you attending our session. Our colleagues from the Division of Security are also in another room. They're doing like Nights of Spamalot, so their marketing budget is way better than ours. So I'm just glad you're here when there's entertainment down the hall. At least I presume it's entertaining. So thank you for coming. I'm going to introduce ourselves here. My name is Sean Barrett. I am the Chief Examiner for the Utah Department of Financial Institutions. We'll tell you what that means here in just a moment. And I'll let my colleague Ty introduce himself.
I'm Ty Bryan. I am the Supervisor of Consumer Credit and Compliance for the Utah Department of Financial Institutions.
Laura, do you want to say hello?
I am a project coordinator.
Laura supports us and helps us with the department's strategic plan, and she's here to help support us. So again, we're grateful that you came. I told my wife, who is a retired teacher, that what can I do to ingratiate myself to the teachers? If I tell them that I'm married to a teacher or a retired teacher, will that help my cachet? She says yes, but don't tell them that I retired in 2019 because that'll just really irritate them the year before the pandemic. So I broke that rule already. Ty and I and Laura, we all work for the Utah Department of Financial Institutions. We're a state banking regulator. There are 50-odd state banking regulators in the country and some federal agencies that we'll talk about in a few minutes. I thought I'd review a little bit with you the mission of the department, why we exist. The Department of Financial Institutions is 100 years old, over 100 years old. It was created in 1913 in its current guise. It dates back to the 1890s, actually before that, as the Office of the State Bank Commissioner. The department's mission is to charter, regulate, and examine both corporations and persons who furnish financial services to the people of Utah. They do that under a couple different entity types that we'll talk about here in a minute. Our main goal is to ensure that the financial services are delivered fairly by safe and sound, well-regulated market participants to the citizens of Utah, market participants who comply with the law. So, like I said, we're a regulatory agency. My slides, they're hugging the side of the screen over there. I tried some different resolutions, options to fix it. Just is what it is. So we're going to roll with it. So when the state regulators think about financial services and the landscape and what we regulate, we usually divide this into two categories. The first is depository institutions, and the second category is non-depository institutions. Can anyone think of an example of a depository institution? What might we mean when we say a depository? Any thoughts out there?
Credit union.
Credit union is a depository organization. That's a great answer. Thank you. Any others? A bank, right? So community banks, credit unions. In Utah, there is a unique class of institution called an industrial bank. We won't spend a lot of time on those today, but they're unique to Utah and about 5 other states. It's a charter type that's available. How about a non-depository? What is a financial services company that you or your kids might engage with that isn't a bank or a credit union? Any thoughts on that?
Like Visa or something like that, like transferring money from bank to bank.
So a money transmitter, yes, that I'll share my list here in just a minute, but money transmitters are on the list. If you're talking about, the big people that move funds, Western Union is probably the biggest money transmitter in the country. Any other examples of a non-depository? Check cashers, yep. If you walk into any Walmart and go to their money center, they can cash your check there. Hopefully you'll see framed nearby a license from our agency, giving them permission to do that in the state of Utah. These are some of the types. Payday lenders, also called deferred deposit lenders. That's their formal name in statute. Title lenders, money transmitters, check cashers, consumer lenders, which can include everyone from Ford Motor Credit, financing a new car that you may want to buy, down to your kid's orthodontist who wants to help you finance your braces. If you offer credit to the citizens of Utah, you register with our department as a consumer lender. Also, we regulate mortgage servicers. So anything on here that might be missing? Can you think of anything else that,
What is like an insurance company called?
wow, you're doing great, dude. Insurance, right? Insurance companies are another, and investment advisors or broker dealers. Those are under the line because I kind of carved them out. My agency doesn't regulate those, but in the state there is the Department of Insurance regulates insurance companies, and the Division of Securities in the Department of Commerce, they regulate investment advisors, broker dealers. So that's a pretty big swath of financial services providers. Who regulates them? I just told you everyone above the line we have a hand in, but I'm going to show you a slide that probably will make your stomach churn and not make you a big fan of government regulation, but it's the hard truth. This is a slide that shows how financial services regulation kind of works in this country. I know it's hard to read from as far away as you are, but down on the bottom left, the white bubble, you see depositories. Those are banks, credit unions, insurance companies. The next bubble is non-depositories, payday lenders, check cashers, title lenders, broker dealers, investment companies, Fannie Mae, Freddie Mac, other market participants. So when you look at that slide, you kind of think, gosh, that's kind of a mess, right? It does. If we were to design this from scratch, it probably wouldn't look like this. This is a result of regulation evolving over 150 years in this country. Innovation brings new financial products to the marketplace. Sometimes they get tested out. And then the government decides, either a state legislature or Congress decides, gosh, we need a way to regulate that product. It's kind of out there operating in the wild. Let's put some controls around it and assign an agency to be responsible for it. And over time, all those boxes up top kind of get created. For the state of Utah, the yellow highlighted box up at the top, those are the state regulators, banking, insurance, and securities. I know, like I said, that slide is pretty intimidating. It's a real complex web. But in some ways, when I showed this to my wife last night, she said, well, in some ways, it provides some comfort to know that basically most financial services and most products in this country at least have someone in charge of making sure they're delivered fairly and safely. So as gruesome as that slide is, hopefully it also is a little bit comforting to know that there's a cop on pretty much every beat. That's us, that little red box there, that's the banking department here in Utah. So who regulates non-depositories? In the United States, it's mostly the states for the most part, payday lenders, title lenders, consumer lenders. For the depository institutions, it gets a little more complicated because if, how many of us are here? Maybe 25 of us? If the 25 of us decided, you know what, we want to start a bank, we want to open a new bank, let's pool our money, we'll provide the initial capital. One of our first decisions that we have to make is, do we want our license, or what we call the charter, do we want our charter to come from the state of Utah, or do we want it to come from the federal government? So you can have a federal charter, or you can have a state charter. Federal charters are regulated primarily by the federal banking agencies, mostly the OCC, which stands for the Office of the Comptroller of the Currency. I don't think you need to remember that today. And then also we could opt instead for a state charter. Bank organizers have that choice when they want to create a bank. Yes?
So is that why there's like national banks versus state banks, like in their name?
Yep.
Not
Yep.
that they're even not a national bank, like spread across the country, but just that they're chartered national.
Yep, it kind of tells you who their charter type is. You don't have to put state in your name, you don't have to put national in your name, but like Zions Bank, whenever I tell my neighbors I'm a bank regulator for the state of Utah, they always want to say, how's Zions doing? And I get to tell them Zions Bank is a national bank, I don't regulate them. But State Bank of Southern Utah is a good example. That's a bank that chose to put state in their name. We do regulate State Bank of Southern Utah down in Cedar City. So the states and the federal government both kind of work the banking industry as regulators together. I want to talk a little bit about how different the United States can be on the global stage when it comes to banking and how it gets regulated. Here's a map of North America, Canada up there on top and the United States below. So let's think first about Canada. Does anyone want to wager a guess? How many banks exist in Canada? Anyone got a guess?
20.
20, somebody said. Okay. Any other guesses? That's a pretty good guess. How many credit unions in Canada? 450? Wow, those are pretty good guesses. There are 35 banks in Canada and 200 credit unions. If we compare that to the United States, you're going to see those numbers dramatically different. Anyone got a guess? Thousands. The answer is there are 4,700 banks in the United States, 4,750, and there are about 4,650 credit unions. That's a lot, right? Compared to Canada, which looks a lot like Germany, which looks a lot like the UK and France. They kind of opt for bigger banks and fewer of them. I think the presence of so many different institution types in the United States reflects kind of a zeal for entrepreneurism. Like I said, if the 20 of us can put together enough money and a business plan that makes sense, and we're willing to submit to regulation, we could go and apply and ask to organize a new bank and create a new bank in a new community. If we wanted to pool our money and donate it, we could create a new credit union. We'll never get that money back because credit unions are nonprofits, so they don't have stockholders per se. The members of the credit union own the equity of the credit union versus a bank, which is a for-profit corporation. Stockholders own that. So if we look just at Utah itself, anyone want to hazard a guess? How many banks and how many credit unions in Utah?
40.
40.
40 banks and 30 credit unions.
Are my answers up there somewhere? Because you guys are doing great. There are 41 banks headquartered in Utah. That includes both national banks and state charter banks. And there are 56 credit unions in Utah. So there are more banks organized and doing business in Utah than there are in all of Canada. I find that pretty remarkable, right? Just to give you a little peek at what Utah looks like compared to the national stage, at the top of this chart are the 7 largest banks in this country. JP Morgan Chase, Bank of America, Wells Fargo are the 3 biggest. Citibank also up there. Each of those is over $1 trillion in total assets. JP Morgan Chase is $3.5 trillion, right? If you go down the list, though, you don't have to go very far until you start running into banks in Utah. Morgan Stanley Bank is a national bank headquartered in Salt Lake City. It's the 18th largest bank in the country. American Express is here as a national bank. It's the 21st largest bank in the country. Ally Bank is the largest bank that we regulate. That SMB stands for State Member Bank. Zions Bank is on the list at number 31, and then you kind of go down the list from there. So a good showing, I think, for little old Utah when it comes to assets under supervision in the state of Utah. Utah has a really thriving, active banking market. All right, I'm going to show you a couple pictures. I'm going to ask you a question. So if you can tell me, what do these have in common? Money. Businesses. Those are inventions. Okay, that's what I'm going for. So this is my brain. Those are some great inventions of the 20th century, my personal favorites, right? Central air conditioning, the internet, commercial air travel, the transistor, which made most of the things I just mentioned possible, the automobile, and then just for fun, I threw on there my favorites. I don't play guitar, but I'm a big fan of guitar. And Diet Coke, of course, got to keep that on the list. So not on the list here is something that I think is a great invention created in America in the 20th century that quickly got exported and mimicked around the world. And that is the creation of what we call federal deposit insurance, right? The FDIC was created in 1933. The National Credit Union Administration was created in 1934. Anything happening in the 30s that you can think of that would have prompted the creation of those agencies? It was the Depression, right? I today think about putting my money in a privately held bank in a small community before 1933, and I just can't imagine it, right? To know that on a whim, rumors start spreading through the neighborhood and the communities, and by dinner time, I've lost all my money, right? Because I didn't go to the bank fast enough. It's that old thing about you see a bear in the woods, like I don't have to outrun the bear, I just have to run faster than Ty, right? It's the same thing when a bank run happens. You don't have to, you just have to outrun your neighbors to the bank. Well, fortunately, when we created federal deposit insurance, it really took that element of panic off the table and preserved money for American families ever since.
Took it off, or should have taken it off?
Well, there is still panic. I think a lot of it's unjustified because, as we'll see, well, for at least the average American, the insurance limits on deposits are $250,000 per account. There is a way, if I have $250,000, my wife has an account, she's got $250,000. If we have a joint account at $250,000, you can capture more deposit insurance from your bank than just your single account.
We're teachers, so that doesn't matter.
Now, if we're running a business and we've got a $3 million payroll, suddenly we have to start thinking about those things and using our wisdom and some analysis to make sure that we're putting money in safe institutions, maybe spreading it around to capture that.
Before you move on,
Yeah.
how does Frank Dodd impact the FDIC?
The Dodd-Frank Act?
Yeah.
So the Dodd-Frank Act was some reforms that were passed during the last financial crisis in 2007 and 8. I think Dodd-Frank was adopted in 2010. And it was really meant to try and address too big to fail institutions. There is a sense sometimes that our largest banks in this country are just too big, that if they were to have troubles, the federal government would never let them fail naturally of their own account. And it strove to try and remedy that by imposing new requirements on them, essentially raising capital requirements, forcing a bank somewhere. If you're a bank that originates mortgages, you used to be able to sell those as mortgage-backed securities off into the marketplace, and you didn't have to hold a lot of capital for that activity. That's changed. Banks now have to hold capital even if they're securitizing the assets that they create. And Dodd-Frank raised the insurance limit from, I think it was Dodd-Frank, or it could have been a companion piece of legislation, but the insurance limit used to be $100,000 for most of my life, and it was raised during the financial crisis of 2008, 9, 10, up to $250,000. And last year there were new discussions like, is that even still the right number? Maybe it needs to be raised again. Congress debated that, but then quickly, as they like to do, moved on to other crises.
Didn't Silicon Valley Bank prove that all deposits are insured?
So Silicon Valley Bank, we've got a video that we'll show in a minute. Do you mind if we table that until we get there? Let's talk about that when we get there. It's a great question. Did I answer your question, sir?
You can move on. No, but you can move on. I'll probably.
Okay. So what makes banking unique in the United States? One of the things I mentioned is, there's so many banks and there's a lot of diversity in our banking community. One of the perils, I think, of having too few banks in a system is the types of products get really limited. The risk appetite gets condensed to just what are the opinions of these 10 boards of directors? That's what that country gets for credit. Whereas when you've got 4,700 banks, some of them are credit card banks. Some of them are banks that specialize in subprime credit, where they're willing to lend to people with credit scores that maybe are challenged in obtaining credit. So the diversity, I think, creates and fosters some financial inclusion. Banking really is a unique kind of hybrid private-public ecosystem. If the 20 of us open that bank, 9 o'clock Monday morning, we open the door, literally the public will walk in and hand us their cash and then walk out, and we get to do other things with their money, right? That wouldn't be true in most other business types, right? But banks are entrusted with the ability to take the funds from the public and then turn around and hopefully create some public good by extending credit in the community, making loans to small businesses, helping businesses make payroll, providing liquidity in the system. And then banks also have to return through something called the CRA, the Community Reinvestment Act. They've got to reinvest in their communities by supporting low-income housing, programs like, I think Junior Achievement was the program just before us. A lot of the volunteers and their pictures were bankers out volunteering in the community. So it's our capital that created the bank. We're the stockholders. We get to derive the profits from the bank, but it's the presence of federal deposit insurance that lets us have those guaranteed liabilities that the public will entrust us with their money. And that comes with some trade-offs. We can be a bank, but we got to really, have a gut check here, because it's going to come with some hefty handcuffs, like regulatory limits on our operations, things that we can and can't do, limits on our behavior, obligations, like I said, to create some public good and return some credit into the community. Because federal deposit insurance unlocks a lot of doors for these institutions, the bar is kind of high. Not anyone can just open a bank. Like I said, we'd have to apply. And we try and make sure that, the Tony Sopranos of the world aren't allowed to own a bank. When you do have a charter, it unlocks for those organizers access to low-cost funding in the form of deposits. It gives them the opportunity to borrow relatively affordably from the Federal Reserve. Banks get access to what we call the payment system, where they can move money, wire transfers, ACH, moving money between customers and even across banks and around the world. There are money transmitters in the country, but there are plenty of payments companies that rely on a bank to do that behind the scenes for them. Having a banking charter also lets you operate nationwide under a single banking license, which is a real benefit when you're talking about regulatory burden. So why do we regulate banks? Why do we treat them differently than we do, say, if the 20 of us decided to go in and open a Subway franchise somewhere where we're selling sandwiches? No one really, I guess, other than the health inspector is going to come and regulate us. Our financial statements are our own. They're private. We get to kind of run our own private business. So why do we treat banks a little bit differently? Well, first, the presence of bank regulation hopefully fosters public confidence in the banking system. It protects consumers and depositors. We are out there trying to determine whether or not they're adhering to laws and regulations. We strive to ascertain the bank's solvency. When a bank fails, we want to make sure that we're minimizing those losses to the government deposit insurance programs. And then sometimes there are missteps when banks make mistakes or treat their customers poorly, which hopefully doesn't happen very often. We do provide corrective measures to try and bring the bank back in line. Some of the strengths of the banking system in the United States and elsewhere are usually some of those trade-offs that I said. They come with handcuffs. There are statutory capital requirements. Banks have to hold a certain amount of capital and equity. That's so that when the bank starts suffering losses, if they've got bad loans or whatnot else, that the shareholders kind of eat those losses before the FDIC or the NCOA has to do so. Banks are required to be audited. Banks' financial statements are public, even though they're privately owned banks. Some are publicly traded, some are privately held and owned by families. But you can go look up your bank's financial statements, even if it's privately held, on the internet tomorrow. They're required to be transparent. There's corporate governance requirements, like I said earlier, activity limits, and then the examination process, where the bank examiners are out there routinely assessing the capital strength, the profitability, loan quality, how much liquidity the institution has, and whether or not it's got good, sound corporate governance. We examine for consumer compliance. Ty will talk about that in a few moments. And then we do information technology exams, and we examine for money laundering as well. There are programs for resolving troubled institutions. Generally, banks fail or credit unions fail when one of two things happen. They either run out of liquidity, which means they don't have enough cash on hand to meet the withdrawal demands of their customers, or when the shareholders' equity gets depleted down to zero and the losses have been so severe that there's no more capital left in the organization. That's also a cause for closure. Usually, the state or the OCC, in the case of a national bank, they close that institution. The chartering authority takes possession, quickly appoints the FDIC to be receiver. Receiver means that they're in charge of kind of cleaning it up and trying to rehabilitate the customers there, let them find new homes, get them new bank accounts. One of the real perks of federal deposit insurance is, while tragic, bank failures are not fun. It's sad for the shareholders, it's sad for the employees of the bank. But for most of us average people, if my bank were to fail on Friday, I shouldn't lose any sleep. It'll reopen Monday morning under a different name. The worst that could happen is maybe I'd have to order new checks, right? But when was the last time you wrote a check? Right? It will be a smooth transition to a successor institution that takes over and your account will persist. Yes?
So how does, as far as like, who pays for that?
Who pays for?
So do banks have to pay for that insurance, or is it really footed by everybody in the U.S.?
That's a great question. Just like your question, I'm about to answer it in a little video clip I'm going to play. So let's watch, and I think it'll be addressed there. I think I have to close this presentation, so bear with me. Flip over here.
This is a run on a bank. This is also a run on a bank. And while these people lost their money, these people didn't, thanks to a government agency designed back then.
We do not want and will not have another epidemic of bank failures.
The FDIC exists to ensure your money is safe and that bank closures don't rattle the U.S. economy. Here's how it works and what happens when your bank fails. Let's start back with these people in the middle of the Great Depression. They were afraid their banks would go out of business and their money would vanish. So they'd run to withdraw it all first. But the issue, as President Franklin Roosevelt explained at the time, was
when you deposit money in a bank, the bank does not put the money into a safe deposit vault. It invests your money in many different forms of credit.
He means your bank doesn't have enough cash on hand to pay out all their accounts at once. Not back then or today. So during a run, the bank would have to suspend business, and most would then completely fail. Thousands of them did, which just made other people panic about their money, so they'd run to their bank.
And that's how a bank run on one bank can become contagious to other banks.
So FDR signed the Banking Act of 1933, creating the Federal Deposit Insurance Corporation, the FDIC, to make people have faith their money was safe in a U.S. bank. It worked.
Your government does not intend that the history of the past few years shall be repeated.
The FDIC is what it sounds like, insurance. For every $100 you deposit, your bank has to put a few cents into the FDIC's Deposit Insurance Fund. This is what's used to reimburse you, the depositor, should your bank fail, but only up to a certain amount. Currently, if you have $250,000 or less in a bank, all that money is insured. Any amount in a bank account over that is uninsured. You could, in theory, lose it if the bank fails. This applies not only to personal accounts, but also to businesses. When a bank is on the brink of failure, the FDIC, along with a regulatory agency, gets involved. Typically, they arrange to sell the bank to another, usually larger bank, then close the failed bank, trying to make the process seamless for the bank's customers.
Taking the failed bank, selling it to a healthy bank, will ensure that there's continuity of services to the community that the bank serves, not just protecting insured deposits, which the FDIC always does, but usually the buyers would pay enough to cover the uninsured too. They wanted the uninsured because those were large deposits, and then also continue servicing the loans, keep the credit lines open, all the services the bank provides.
Over the years, most failed banks have been small. Here they are scaled by size. Except for this one, Washington Mutual in 2008, the largest bank failure in U.S. history. Most of the accounts, primarily personal accounts, were insured, and the bank was sold for enough money to cover the insured, no need to even touch the deposit fund, but also cover the uninsured accounts. But the bank failures of 2023 haven't been routine. With Silicon Valley Bank, the vast majority of depositors had accounts with more than $250,000. So they're uninsured. It's a lot of businesses. And because the bank began to fail so quickly, the FDIC hadn't lined up a buyer before they had to close it.
Their deposit base was a very close-knit group of VCs and their portfolio companies, and word just spread like fire. When a couple of them got worried, they all started to run.
So the U.S. announced,
all customers who had deposits in these banks can rest assured. I want to rest assured they'll be protected.
Experts say guaranteeing not just the insured, but also the uninsured was aimed at stopping any further economic damage from these businesses not making payroll, but also might have stopped other uninsured account holders from running.
If the uninsured depositors in bank A can't access their funds, that's going to make the depositors in Bank B nervous. We have contagion, and then we're back to 1933.
Reimbursing all these depositors will come from the eventual sale of the bank, and also from the insurance fund. Many experts are worried the amount banks have to contribute may go up, so your bank fees could too. A process that, while messy, worked the way it was designed nearly 100 years ago.
I can assure you, my friends, that it is safer to keep your money in a reopened bank than it is to keep it under the mattress.
I think on the one hand, FDR would be wincing and saying, oh man, I thought we wouldn't have screw-ups like this. On the other hand, I think he would smile and say, it didn't spread. We haven't had contagion. We haven't had widespread runs. That was my goal in creating the FDIC.
Okay, so let me, there were a couple questions earlier. Your question was who pays for it, right?
A federal jury found Hunter Biden guilty of 3 felonies in his gun case. The verdict capped a high-profile trial.
There we go. We're back? Okay. So your question was who pays for it? The banks pay for it through, just like any insurance, they pay a premium to the FDIC. On the NCUA side, the credit unions pay a premium to the NCUA for their deposit insurance, and it's how much they pay depends on how big they are, how risky they are, how much capital they have, what types of loans they make, what their credit quality is. Riskier banks pay a higher premium. Less risky banks, more conservative banks pay a smaller premium. If there were big shortages in the deposit insurance fund and there were surcharges, ultimately, who's going to pay for that? Probably bank fees to customers to try and recoup some of that. But for the most part, your banks have been paying their deposit insurance premiums for generations without a lot of knowledge by the customer base as to how it's affecting their fees. In practice, I don't think it does very much. And your question was, did Silicon Valley demonstrate that all deposits are,
Or should they be?
or should they be insured?
They work for one bank, so should they be for other banks? When the little guy loses, when the big guy loses.
Yeah, it was a really controversial decision. Used and deployed. There is, I guess, I didn't know it until the crisis was upon us, that the FDIC and the federal banking agencies had this wild card in their back pocket where they could say, in a special circumstance, we can cover uninsured deposits. Decisions were made by those policymakers to do so in the case of Silicon Valley Bank. Silicon Valley was a really unique case. As you saw, the amount of uninsured deposits to insured deposits in that bank was very atypical. And so all I can tell you is a one-off decision was made to do something different in that case. Would it be repeated? I think that is an open question that we have to wait and see what time will tell. There were conversations at the time in both Congress and congressional hearings about should we, right? Why pretend with these caps, quote unquote. But today, your deposit insurance limits are $250,000, and I think everyone should plan and act accordingly, is how I would say. Yeah.
So by planning and acting accordingly, just keep each account less than $250,000.
Yep, you're up to $250,000. Like I say, you can manage the way your accounts work to get more deposit insurance. If you are in a position where that might apply to you, I would encourage you to talk to your banker about how to help you set up your account so that you can expand your deposit insurance coverage. The FDIC has resources on their website that will teach the public about deposit insurance and how to structure those accounts so that you can maximize your deposit insurance.
So people who have lots more money than $250,000 in an account, so they're probably putting it into some account that they can invest in, kind of they're almost like their own little bank, go out and invest in doing stuff.
Yeah, if your money's in a bank, your federal deposit insurance will apply. If your money is in a broker-dealer and you're in an investment account and it's more than $250,000, federal deposit insurance limits don't apply to your investment accounts, right? So you should work with your securities firm, your broker-dealer, because there are near equivalents of federal deposit insurance for investment accounts. all investment accounts are not guaranteed to never lose money. I mean, there is the risk of loss in an investment account. So they're not guaranteeing your money won't ever lose, but they will protect you against fraud or the complete collapse of a large broker-dealer. There is a fund like the FDIC Insurance Fund to help resolve situations like that. But your money in an investment account is unlike, if I have $50,000 in a CD at a bank, I should never, my principal is not at risk. If I have $50,000 in the market through a broker-dealer, there's no expectation that my principal won't decline below 50,000, right? Questions? Yes?
The money that the banks and the credit unions pay into this fund, what they do with that? Do they go invest that? What do they do with it? Where does it go?
Where does it go? That's a great question that I'm sure it helps fund the operations of those agencies. They each have about 4,000 employees. And buildings to maintain and training centers. They also, I'm sure, somehow it gets used with the Treasury. I don't know if my colleagues know more about that than I do, but I'm not an FDIC employee, so I'm not quite sure how it gets used. Okay, I'm going to keep going. Thank you. Great questions. Ty is going to talk for a few minutes about the consumer side of what we do in terms of consumer regs.
Excellent. My spouse is not a teacher, so I can't endear myself to you that way like Sean did with his wife being a teacher. But I am a father of 3 children. I've got a 10-year-old, a 12-year-old, and a 14-year-old. Anyone teach kids that age? Do we have any Provo School District teachers here by chance? So that's where my kids go. And I'm excited to go home and report something back to them. Because every year in my kids' school, they do, go with your parent to work day. I don't know what they call that, but, you can go shadow your parent and see what they do for a job. Well, every year, none of my kids ever come to me and say, I would like to go to work with you. And every year I kind of wait. Hey, can we come to work with you? Never happens. So finally, this last year, I asked my kids, I'm like, why don't you ever want to come to work with me? And they said, because your job seems really boring. So fast forward to last night, I do a run through of this presentation with my kids, and they're like, yeah, your job really does seem boring. So I'm happy to go back and report we had some great audience participation, so my job's not as boring as they think it was. I've got a lot of information I'm going to try to cover really quickly. So if there's something I skip over, you can refer to the slide deck. But I'm going to talk about a part of our business that we regulate, which is consumer compliance. So I've got a group of teachers in the room. Can anyone give me the meaning of the word compliance, or your best guess?
Obey.
What's that?
Obey.
Obey. Follow the rules, right? Compliance. The definition that I found said compliance is the state of being in accordance with established guidelines or specifications, or the process of becoming so. So obeying, right? Following the rules. When we talk about consumer compliance in consumer compliance in banking, and I'm going to read this. So consumer compliance in banking refers to the adherence of financial institutions to laws, regulations, and guidelines designed to protect consumers in their financial transactions. So protect is really the key word there. Consumer compliance is all about consumer protection. And some of the key objectives when we talk about consumer compliance in banking, it's there for transparency and to allow for informed decision making. It allows consumers to really control their decisions when it comes to loans or deposit accounts. It ensures fair treatment and non-discrimination. It helps to prevent unfair, deceptive, or abusive practices, which is also referred to as UDAP. It ensures privacy and data protection. We're all concerned about that, right? We want our data protected with our financial institution. It helps with error resolution and consumer rights, promotes financial stability and consumer confidence. It allows access to credit and financial inclusion, non-discrimination in credit and financial inclusion. And it helps to protect against, vulnerable populations. We call this the alphabet soup. For any of you familiar with banking, there are a myriad of banking regulations ranging from A to Z and even AA, DD, These are just a few of them, a few of the financial protections, the more common ones that are in place to protect consumers. We talked a lot about the depository insurance. Truth in lending is one of the protections that helps protect consumers in lending transactions. The truth in savings ensures clarity in deposit opening and deposit accounts. We've also got the Equal Credit Opportunity Act and a couple of others there that you're welcome to look at your leisure. There are a number of, yes, sir.
What about hacking protection?
Hacking protections.
So somebody hacks the bank and takes all the money.
Yeah, so Regulation E covers some of that. That provides, I guess, electronic transactions is what that covers. Some hacking, if it's fraudulent, where you gave your information to somebody, the bank is not liable for that, but that would likely fall under Regulation E. There are a myriad of institutions, both federal and state, that regulate consumer compliance. We've got a listing of them up there. Sean talked a little bit about the NCUA, the National Credit Union Association, the FDIC, the Federal Deposit Insurance Corporation. There is the Federal Reserve System, or the FRB. The CFPB, which is the Bureau of Consumer Financial Protection. This is one that there was a question about Dodd-Frank. The CFPB was organized as part of Dodd-Frank back in 2010. We've got the Office of the Comptroller of the Currency, the OCC, and then of course us in the center, UDFI. And like Sean said, there are 53 approximately state regulators for the 50 states and the US territories. So when a consumer, a banking consumer such as yourself or possibly one of your students, feels like there may have been a violation of one of these consumer protection laws, or they have an unresolved issue with their financial institution, they can file a consumer complaint. And that's one of the things that we do in our agency is we field consumer complaints for the agencies that we regulate. Some of the complaints that we receive deal with issues of fraud, access to funds, high interest rates, credit reporting problems, and security concerns. So let me ask a question of the audience here. Has anyone here ever filed a complaint, not necessarily with your bank, but any company you do business with? Had a complaint about your contractor, maybe you dealt with a sour employee at Walmart. Anyone ever complained? I know I have. I've had to file a complaint before against someone I've done business with. Is it easier to file a complaint or to have systems in place that might prevent the issue from happening in the first place? Right? Prevention is better, right? That's kind of a give me question. So what I want to focus on for the next few minutes is things that you can do and that you can help your students to understand to protect themselves as banking customers and avoid an issue where they might have to file a complaint. Number one thing is you're educating your students. When entering into a loan contract, know what you're signing or agreeing to. Understand the rates and fees associated with the loan product. Has anyone here familiar with TILA disclosures or the truth in lending disclosures? That's the part of your loan contract where it outlines the fees, the number of payments, the monthly payment amount, what late fees might be. I was in banking for 20 years. It's amazing how many people don't pay attention to that. And that's critical in the loan process. Y'all have probably seen this box before that outlines the annual percentage rate, the finance charge, the amount financed, and the total of payments. This box is required on all consumer loan contracts. Important things that I tell people to pay attention is that finance charge. Oftentimes people want to sign on the dotted line. This is something to really educate your students on when entering into a loan contract. The next part of this process is when opening an account. Understand what you're agreeing to and the product that you're purchasing. Rates and fees. Again, I was in banking for 20 years. People come into the bank all the time or the credit union. Hey, I have a fee on my account and I don't know what this is. Understanding fee structures, the rates that your account should be paying. Before Purchasing a deposit account is critical to the process. That stack of disclosures you get when you open an account, really easy to slide those to the side. But again, those are critical in understanding the structure of the account. High yield savings versus regular savings. Anyone here ever heard of a high yield savings account? Yeah, so understanding the terms of the high yield savings. It's like, hey, I thought the savings account was going to pay X. It's like, well, but these are the requirements to get the X rate. So that's what the Truth in Savings Act is for, is to help provide transparency in that. And that's what those disclosures contain that your financial institution gives when you open an account. Yes, sir.
Those are really annoying commercials because they're always like, oh, you can get like 6% interest on if you join our bank. And then you go in and they're like, yeah, if you have like $200,000.
Right.
And it's not like small amounts, like, because we were looking into doing some.
Right, and that's
$200,000 on cash.
Make sure it's in a bank and it's FDIC insured, so you're good. Not under the mattress. No, that can be frustrating, and that's why those disclosures are important. So you don't go in with one idea and the result is somewhat different.
But just, I don't know, I guess I do teach marketing as well, so I understand from the marketing perspective why you do that. But
sure.
It just seems disingenuous, right? That they're
I get
telling
that.
everybody, oh, hey, and then at the very last second they're like, certain restrictions. And then you go in and you're like, okay, like very few people are actually going to be able to do this.
Yeah, understandable. Another way to protect yourself as consumers and talking points for your students is to have a backup plan. I'm sure these are all concepts that you're familiar with. Backup plan can consist of a savings plan. We just sat in for a junior achievement session and they talked about classes they offer to help people, build a budget and start with a savings plan. Really great key concepts. Improve your credit score. Sometimes I understand that's easier said than done, but that consists of paying bills on time, reducing outstanding debt. Consolidate balances is a great way to help improve that credit score. Looking for secured or collateralized lending versus unsecured lending. The rates are very, very different on those types of loans. And then credit counseling. There is credit counseling available. Hopefully none of your students are at that phase yet in their lives where they would need that, but there are options available to help people. The last thing I want to talk about is fraud prevention and monitoring. A couple of key concepts on here. So we talked about this, which is better, prevention or monitoring? Always prevention, right? There are ways that you can protect yourself against fraud. One of those ways is not just through credit monitoring, but through credit freezes. Anyone heard of a credit freeze before? It's where you can reach out to the credit bureaus, there are 3 of them, and ask that a freeze be placed on your credit. And the only way that your credit can be pulled is if you call to have that freeze taken off, and there's a verification process. That ensures that no one can access your credit really except for you, unless somehow that verification process is compromised. Yes?
Is it true that you can freeze the credit of a child?
You can, yes. My boss that I work with, she is a big believer in that, in freezing individual credit and credit of children. Credit monitoring is another way that you can protect yourselves against fraud or identify it quickly. You're entitled to a free copy of your credit report annually or anytime that you are denied credit through the 3 credit reporting agencies. There are also a myriad of credit monitoring companies out there that will monitor your credit for you. Just ensure that it's reputable if you choose one of those. The credit reporting agencies is generally a good bet when it comes to credit monitoring. Monitor your accounts. I'm sure everyone's got that app on their phone of their bank or their credit union, their financial institution. If your institution offers it, sign up for email and text alerts to be notified of suspicious transactions. Monitoring is key. and then maintain records. It's not enough just to rely on, the app and the balance on the app. A good old-fashioned ledger can save a lot of money, or it can really be a good tool for detecting any fraud that occurred on your account. There are some resources that I want to touch on really quick. One that you might find helpful as educators at the top, the FDIC resources. If you go to this web address and you click on Protecting Consumers from Financial Harm, there are a myriad of resources available on there. There's a program called Money Smart. It's a financial education program, and it's a great program for students and for educators to help teach good financial concepts and some financial literacy. Also, if you've been a victim of fraud, you can go to ftc.gov, and you can go, there's a drop-down menu called Advice and Guidance that's got some great resources there as well. And then there's our web address, the last one, dfi.utah.gov. A major goal of our department is really there to help citizens of the state of Utah. And if you have an issue with your bank that's unresolved, help is available either through us or one of the federal agencies, and we are here to help you. You can go to our web address. There are two banners on the side, one that says give feedback and one that says need some help. You can click on that need some help banner, send us a question about your institution, and we can either field that complaint or answer that question or send it to one of the federal regulators that can help. On this last slide, we've got Sean's email address, we've got my email address. I know we're coming right up against our time. If you've got any questions that we haven't answered today, you need any help with anything or resources, you're welcome to reach out to either of us anytime.
We added those email addresses after I printed, so they're not in your desk, but if you want to capture them, you might want to write them down, but you can find us on our website. We're always here to help.
Anyways, thanks so much for joining us. Y'all do fantastic work. We definitely appreciate teachers and your role in financial literacy. So thanks for joining us today. We appreciate it.
Thank you.